Hello and welcome to Investors Hangout, your weekly guide to making smarter financial decisions. This series is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, in the backdrop of the recent trade tariff announcement by the US and the market chaos that followed, today let's discuss the psychological and practical aspects of investing during volatile times. Well, to do that, I'm joined by our in-house expert Dhirendra Kumar and Sidharth Damani. He's the head of investor education and distribution development at Aditya Birla Sun Life AMC. Welcome, gentlemen.
Thank you. Thank you so much.
So, Sidharth, I'll come to you first. You have close to 3 decades of experience in the industry, and you must have interacted with a lot of investors. So, according to you, what are some of the biggest misconceptions or knowledge gaps that investors have during such times?
So firstly, thank you for inviting me to your channel. Really appreciate it. And this is something which has been talked about so much recently. And if I were to take you a bit in the past, I think we all knew that volatility is there in whichever shape and form. People were looking forward for a correction, but no one knew in what way or shape it'll come.
Yeah.
So when we see today, and I think I'll give the acknowledge and credit to the investors currently that what we've seen in the past and now, of course, there's much more maturity. That thing about buy high and sell low, at least I think through such initiatives, we've seen that maturity levels are going up. But still, of course, sitting in India, we can't say that we are averse to what's happening globally,
right,
or whether anything which is happening domestically or macro on the macroeconomic front. What I see is that with this scenario today, you certainly are seeing that though maturity levels are going, but when such high volatility sets in, people do panic, because they are seeing the portfolios in red, especially for someone who's come post-COVID and has only seen a one-way movement in the portfolios. When you see that in the last 1 year or whichever period you've invested in, your portfolio is in red, there can be a tendency to okay, I'm making such losses, what should I do? Why? Because many times we've seen that when such in bull runs, there is a herd mentality where what's good, what's the trend, or what is being talked about, or which is the best performing stock or a mutual fund scheme. I think that's one area which a common mistake people make. So just for example, if you see in the last year and a half or two, a thematic fund has become the largest category in terms of assets under management for the mutual fund industry. But for someone who's recently got into capital markets or into mutual funds, one should be coming into a diversified large cap category. So if you're getting into something which is high beta and something which is volatile, I think that's one area. And I think more importantly is about everyone is different in terms of their financial planning.
Right.
So one, I think the old age thing still continues, and it's much more strong as I talk. Is you need to have a financial plan before you decide that which financial product is going to take you or make you achieve that thing. So that's one area which I've seen that somehow we've gone a bit haywire on when I talk to investors. But then it boils down to one thing, that there's nothing or there's no substitute to asset allocation. So one should be looking at asset allocation. In equity itself, how are you allocated to a small cap, large cap, diversified is the thing. So that would be my answer to this question of yours.
You were just talking about how investors tend to go after a product rather than a plan. I was going through this very interesting campaign by your AMC, the Sabse important plan, basically renaming of SIP.
ये है मिस्टर सैनी और इन्हें है बड़ी बेचैनी। कुकिंग रील्स के बन गए फैन और बनाया खुद का कैफे खोलने का प्लान। जब साथ बने फ्राइड राइस, लॉलीपॉप, तो कस्टमर बढ़ते गए नॉन स्टॉप। एक कैफे के हो गए 4, बढ़ता गया फैंस का प्यार। ऑटोग्राफ, सेल्फी, इंटरव्यूज, पर इतने में प्लानिंग का उड़ गया। क्योंकि मिस्टर सैनी भूल गए उनका सबसे इम्पोर्टेंट प्लान यानी SIP। तो अपने ड्रीम लाइफ को सिर्फ डे ड्रीम मत बनाओ, उसे पूरा करने के लिए SIP स्टार्ट करो। एन इन्वेस्टर एजुकेशन इनिशिएटिव बाय आदित्य बिरला सन लाइफ म्यूचुअल फंड।
म्यूचुअल फंड निवेश बाजार जोखिमों के अधीन है। योजना से संबंधित सभी दस्तावेजों को ध्यान से पढ़ें।
Would you like to elaborate a bit on that?
Certainly. So SIP is something which has got such airtime and such visibility for the industry and us. So a few months back when we were strategizing that, how do we promote it? And I think what we got inspired by or focused on this was, when we saw a lot of SIPs which the industry has been garnering over the last so many years. SIP book itself has swelled more than 3 times in the last few years.
Yeah.
When you start seeing people going a bit haywire in terms of cancelling or stopping their SIPs before before the actual term what they signed for. Of course, it's one can do it any time. We said that why not we coin it as SIP is something which is a plan, and why it should not be the Sabse important plan of your investment decision making. And there itself is that everyone has an aspiration, and aspirations can be short term, medium term, long term. When we talk about these aspirations, many times these aspirations remain dreams. That I wish to buy a 2-wheeler in the next 3 years, or I wish to send my child to US after 5, 7, 10 years. But when it comes to investment decisions, at times we've seen that people also tend to delay it.
Yeah, people don't act.
They don't act.
Yeah.
I think we are asking people that you're different, sir is different, I'm different. That आपकी life का सबसे important plan क्या है? So it came about that if you're planning something, you're dreaming for something, you have to plan. But planning is not enough. You have to act on it. Execute. And that's what it is all about. That if you don't act, and if you don't make it happen, and at the same time you have to be disciplined enough to ensure that you live through it. The volatility what we talked about. So at a young age, if you have a long-term view, of course you love such volatility which we are experiencing currently.
Right.
So I think that's don't go haywire. So if you have a plan, you're acting on it, you have to stick to it. It will be volatile, but if you're very clear in terms of what you've planned, you're going to do it. And that's how I think we are very, very excited about this. So when someone's coming for this investor education initiative of ours, and I think we've seen amazing amount of traffic coming to our microsite of our investor education
Sabse important
plan, where we get the investor or the prospect to come, and also it's gamified, and that we've got a SIP calculator where one can put in what you aspire to for, what it would be in terms of value, what you want to build, or the kit you want to build,
how much can you accumulate over time.
And it just in a very, very simplified way, in few seconds itself, it creates something in terms of that, okay, this is personalized for you.
Right.
And then it makes you very comfortable and also convinced that yes, I thought about it, I planned it, and now I'm acting on it, and I'm going to stick to this plan. So that is such an important plan, which is SIP.
But Dhirendra, given the current volatility, it really isn't easy to stay invested for a long term. So how can investors build that confidence to stay put?
It is not easy for investors to reconcile with this volatility. Only thing that which can help you reconcile with is your experience. If you have been in the market when COVID was there, if you were in the market, or if you had invested in 2008, then maybe you can appreciate. You will have enough courage that okay, it happens. It does not happen too often. And it is very important for investors, if you have not experienced it, if you have not experienced COVID decline, if you haven't experienced 2008, it is important to read and learn about it. Simply because these crises, the other side of it is that they are also great opportunities.
Yeah.
And if this crisis, if you bail out yourself out in a hurry, you will make your notional losses permanent.
So, why do investors run during such volatile times?
So I think the rule number one is pretty clear that I think don't look at the rear view mirror. What's come or what's been delivered has been the past, but you're investing for the future.
Yeah.
And especially in these times, when we've seen higher returns, for years we've been talking that anything around above 10, 12, 13, 14% CAGR is a great return over a long-term period.
Yeah.
If you start, attempting to say that, no, that's low, something 15, 18, 20, or whatever high returns we've seen, I think don't chase returns, because when you start chasing returns, you end up buying a product or a solution which may not be suiting your risk appetite. And at the same time, as we were talking about, fulfilling your dream or your plan.
Yeah.
So I think that's number one. Number two, as I mentioned earlier, I think it's this, everyone has one's plans, goals, and time. If you're talking to someone very young, of course you've got a lot of time in your hand. Don't be very, very swift in terms of your decision making, because when you become very swift, it's the emotional quotient, and when
That
such
takes over.
volatility, I think that takes over.
Yeah.
You have to stick to it. You have to stick to it, because if you're committed to something in life, if I've committed to something, I have to stick to it. Whether it's life in terms of relationship, marriage, or I think the same thing has to be an investment where it has to be disciplined. And last but not the least is don't go by tips. When I say tips is something where you because X bought, I'm buying.
Yeah.
Or Y because there would have been a different reason for what would have bought. So as we coin is that from tips, the best way is to move to SIPs. Yeah. Why? Because since we talked about SIP, SIP also should not be bought in terms of just going on an Excel sheet or any website and saying give me the top performing fund for the last 3 years, because that's the past. And last but not the least is stick to what you've committed to. And I think age-old thing is very clear that if you have to diversify your portfolio, whether it's a large cap, flexi cap, I think everything deserves a decent portion of your portfolio. So don't go and invest in something which only is high beta or highly volatile.
So, Dhirendra, how can investors strike a balance between maintaining a long-term approach and using these times as opportunities?
It's not easy to reconcile with these times. And how to convert it into an opportunity? If you're an experienced investor, then I don't think you need to convert it into an opportunity. But normally what I keep saying, many a times investors come to me and say that I have this 5 lakh rupee which I have to invest. And then I tell him that, okay, spread this money over 10 months for ease of mental calculation, 50,000, and you will be able to average your investments. Today, if that investor comes, I will tell him that average it in next 6 months. Simply because, we have seen in the market that many of these, because only if you are a long-term investor.
Yes.
If you are going to invest for 10 years, then maybe accelerate your investment, simply because these kind of crisis is not made, it's not a natural thing. COVID we couldn't help.
Yeah.
It looked like a world is coming to an end and we didn't know what the solution was. Here is a man-made thing, and I think men are intelligent enough to not really destroy it. That's my eternal belief. Besides that, I don't think this can linger. This will linger. We are not going to have a solution tomorrow. We are not going to have, but this opportunity will not come again. And most opportunities which you see in hindsight on a graph paper is something which was when you were very scared, when you were in the middle of it. Only with hindsight you can say that, okay, this was the opportunity and this might be one. Because I have never seen the daily swings of the market of this magnitude. I have seen declines, but I have never seen 5% decline and going up another day. This kind of swing, and this is where I think SIP is even more powerful. You should be on, substantial part of your money should be on an automated plan. Automation of savings or investments is one aspect. Second is that if you have any tactical money, put it to work, diversify. And this is not the time when you should be narrowly, focused on any portfolio, with any part of your portfolio. I don't think, one can be little tactical with portfolio only if I have some specialist knowledge. If I have some special understanding about EV and I think that it is going to rule the world, or I have some very great understanding about a sector and I feel very upbeat about it. Maybe I should have 5%, 7%, but I should have it with great understanding. Otherwise, most investors will do well to have a flexi cap or a multi cap fund, and you are able to get all the benefits and far less headache.
Mr. Damani, you have reiterated through our conversation how thematic funds, they are the flavor of the season, they are in the headlines. But how can investors differentiate between long-term opportunities, genuine long-term opportunities, and short-term fads?
Of course, this is something which we keep discussing. When you see that the kind of assets or the flows which are happening into thematic funds, let's understand that these are cyclical. And when something has cyclicality, and especially in these times when you're seeing cycles shrinking, it's a tough thing to first of all identify. And as Sir was rightly mentioning, that these are tactical allocations. As we talk about a core or a satellite strategy. Here, of course, once you're through with your core strategy, you have to start looking at where should I be investing in tactical, and I think that's where these sectoral funds come. And these this can go really wrong for you because you're just looking at the rear view mirror and seeing the past returns. And as he was rightly mentioning, if you don't have the right knowledge about that sector and what's going to drive, for example, as recent as now, with the tariffs getting announced, the IT sector has taken a huge beating in the last, it's almost down by more than 25% this calendar year. If you were invested into a tech fund, one must be seeing huge amount of losses or notional losses in the portfolio.
High volatility is the deal there.
Is the deal there. So if you can't understand it properly, don't get into it. Why? Because that it looks good or it has given great returns. And I think last but not the least is you have to be evolved enough to get into these categories, and more importantly, getting the right advice. Because if you don't get the right advice in terms of when to buy and when to sell, I'm not saying you time such funds, but also at some time, timing also is an important part. That, when are you getting into that fund, and at the same time, when you're getting out. And what I've seen is also a lot of first-time investors have started their investment journey or mutual fund journey by investing through in thematic funds, whether lump sum or SIP. And I think that is something which has to be in some way avoided, because then you're not sticking to what you've planned for. You're just trying to chase something which is fashionable or which has done really well or great returns it's given in the past.
So with increasing fund launches, a plethora of funds being launched on based on factors and whatnot, how can investors decide on a fund that's truly suited to their needs and is high quality as well?
It's very difficult given that there is so much noise created by these new launches. Also, mutual fund is the ultimate consumer product. Ultimate consumer product in the sense that it has to strike a chord with an individual, that he can plan his retirement based on that. He can plan, upgrading his living in 3 years' time or something like that. So they are important goals. So that is why many a times funds are also sold as a story. Story sells. And if somebody is able to weave a story that, here is something which can change the world. And look, that is why it is going up. And look, that is why it has gone up this much. That I think is a trap. That I think is
so how can one cut through that noise? Simply
ignore it. Because if you have to frame a simple rule that you will invest in a fund with at least 3-year track record. If you frame this rule, then all this noise you will be able to overcome. And in these 3 years, and there is something which is very, very distorted about this particular phenomenon, because it has been happening for the last 35 years. There is nothing new in it. But it is always addressing a new segment of the investor. The same investor doesn't buy it. The problem is that, every time a story strikes a chord with an investor is the time when it looks too good to be true. And it actually turns out to be one. Because it has gone through the whole momentum. And when people get excited, that is a time when it is actually not worth investing. And I have seen it time and again over the last 20, 30 years. So keep it simple. 2, 3, 4 diversified equity fund can actually meet and fulfill most of your needs. Never invest the short-term money into equity funds. Then once you have something which is equal to 5 years of your earning, worry about asset allocation, because you will have far greater, because humans are configured that your 10 rupee becomes 11, you feel happy. Your 10 rupee becomes 9, you are very unhappy. That scale of unhappiness, that is why you have to really guard yourself. As you get closer to your goal, start pulling out methodically. The way you do SIP, the converse of that is just as important, because you can't wait for the last day when you need the money on any market linked investment.
All right. Well, thank you, gentlemen, for joining in and sharing valuable insights.
Thank you.
Thanks. So remember, while financial markets can be volatile, they can be unpredictable, but strong fundamental principles can help you sail through. That's all we have for you in this episode. Keep watching this space for more information. If you like the show, do subscribe to our YouTube channel. Take care. Bye for now.